Nicholas Bornos of Capital Link. Thank you to everybody for joining the crude oil tanker panel. Energy is a core topic always, and especially now with all the geopolitical tensions around the world. We have a great group of panelists, and I would turn it over to Chris, our partner in this conference. And by the way, Chris is making, he's moderating 3 panels. He's really shouldering a big burden. So thank you, Chris, for being a great partner. And thank you, Lois. Thank you, Hugh, Brian, Lars, and Harris. And the floor is yours, Chris.
Thanks, Nicholas. Really appreciate it. Yeah, it always is a little bit of a burden when I have to do these these panels. I'm actually just joking. This is a fun one for us to do. We really do enjoy spending time with all the folks here. And the tanker panel, I think, is particularly topical these days, given all the things going on in the world. So I think that's kind of where we would like to start. So this is a fantastic group to ask these types of questions, because they're on the the cutting edge of what's actually happening in the world, and there's a lot happening in the world. So let's dig right in. Lois, you're right next to me on my screen, so I'm going to start with you, just because that's the easiest way for me to go. Let's talk about sort of the current environment, particularly Russia. That's what everyone sort of calls in and asks us about is, what are the specific dynamic changes you're seeing in the trade today because of what's happening between Russia and Ukraine and the sanctions, and maybe even some of the self-sanctioning that's going on with their crude? So maybe the first question directly would be, what's the sort of ton-mile or operational sort of dislocation that's happening in the market today?
That's a big question. So, if we, this morning the guys were looking at, the Bloomberg terminals and just seeing, Urals is still discounted by about $30 a barrel. That's just tremendous. So when you see that kind of a situation, there's going to be buyers, right? So, a lot of the trading coming out of, in particular, the Black Sea has gone a little bit quiet. In other words, a little bit underground, so I think it's become a little bit unpopular to be loading some of these Russian crudes, particularly out of the Black Sea. And so some of that, the traders come in and fill the gap when the oil companies kind of back away a little bit, and certainly are not taking any trading barrels, right? So I think that the Russian crude is still flowing from what we can ascertain and what we see from position lists and fixtures, and that discount is just tremendous. So there's a big incentive for that crude to be going east. So we are seeing that, and this on Friday, CPC pipeline going down, and it does seem to be Kazakhstan barrels, right? So it's where that CPC coming out of there, and Novorossiysk is about 1.34 million barrels a day. And a big piece of that, the Kazakhstan barrels, like 1 million barrels a day, that seems to be offline, but we're going to have to see here from some damage from a storm whether or not that's going to be sustained or temporary. So, this situation is highly, highly fluid, is what I would say. And on the ground, what we see is the product carriers are faring better than crude at the moment, and the V's are sort of the most left out in the cold, with Afras and Suezmaxes having a little bit more of a dynamic, even though rates are really quite low.
Got it. Yeah, no, that certainly makes sense. Brian, maybe a question I can throw your way. What do you estimate Russia to be as part of the sort of overall ton miles of the industry? And I guess, as you think about how the trade evolves, where are the barrels going? I guess that's sort of the question we all want to know.
Yeah, I mean, it's a great question, and Lois sort of touched upon it, like these moving parts. It's very dynamic, but I think we have to remember, take a step back, that shipping works in sort of weeks and months. It doesn't work in hours and days like capital markets do. But on average, the Russian barrels seaborne are moving, I think, 2,000 nautical miles on average. And on a global basis, that would be around about 5,000 nautical miles on a global basis. So you can see a sense of, if you have this general swap out of, if Europe doesn't take the Russian barrels seaborne, which is roughly, say, 1.6 to 2 million barrels, that they're going to have to source it from, say, half the Atlantic, half the Middle East. but we're not really seeing that trade. And you and I spoke, I think, a month ago when this all sort of started, and the consensus was then that the Aframax would have a really outsized impact. And some of the latest intelligence that we've seen would suggest that it's going to be more balanced between Aframax and Suezmax, because as Lois alluded to, that you're going to see a lot of this maybe long haul trade with this very discounted and very attractive oil that the Indians have been very public in wanting to take. It's probably better sourced on a Suezmax. So I'm not trying to duck the question, but I think all of us we're all a little bit feeling in the dark a little bit. And of course, technically, some of the sanctions haven't actually bitten yet. They don't bite until April, and a lot of the stuff that's moving at the moment has already was contracted before the hostilities started. So I think we do have to be in a bit of a wait and see, but absolutely would fully concur with Lois's view that, you know, the VLCCs are very much out in the cold. You can't land a VLCC in the Russian ports. It will be a Suezmax and Aframax market. We believe we're going to have a situation, and our consensus view would be that you're going to see a swap out of European barrels sourced from seaborne imports. You'll replace Russian barrels with overseas barrels from the Atlantic or the Middle East, but you will get a benefit of longer ton miles of that Russian oil being tolerated and being discounted and consumed in the Far East. So we don't actually buy into this view that we heard a lot from a recent trip in Oslo, that we're going to see a lot of these Russian barrels completely taken out of the marketplace. We would sort of concur with the view that 500,000 to 1 million barrels may be taken offline. But again, ask us in a week and there'll be a different answer.
Fair enough. I know it's a very fluid situation, and so it's great to get everyone's perspective. Lars, maybe we could bring you into this conversation a little bit. And what are you seeing in terms of action in the West? So Europe, but then maybe more importantly, North America, in terms of, you know, sourcing barrels and the trade that's developing there. Any of the sort of unique spillover effects of what's going on with Europe and Russia in particular that's impacting these markets?
Yeah, well, it's you know, a lot's been said already, and both Lois and Brian are perfectly correct. But I think just to look at this a bit holistically, so Russia is obviously very close to Europe, and Europe is, although smaller than US, it's a relatively big refining hub. That oil is now seemingly sailing past Europe, either to go to India or to Asia, and then it's being replaced. So Brian mentioned, you know, 2,000 nautical miles average trade, but if you think about it in a matter of days, you know, these voyages kind of from the Baltics down to Europe was 3-4 days laden, and a similar kind of backhaul. So 14 days altogether. These trades are now stretching to be 20 days, 25 days, and so forth. Also, North Sea has normally exported a lot of barrels to Asia. That is now being kind of brought locally. So it's basically going into Europe. We also see US and West African barrels point towards Europe. So it's you're creating this very inefficient kind of trading environment, and this sometimes have a positive effect on overall ton miles. And I would like to second what Brian said, that right now it's not benefiting the Vs, it's kind of hurting the Vs. But again, you know, kind of how this plays out is going to be difficult to assess, because all of a sudden Middle East is exporting barrels to Europe, and then suddenly China needs to bring barrels from further afar. So kind of where this ton mile balance gets substituted when you you increase a certain part of the trade, it's almost impossible to say.
Okay. Yeah. No. Fair enough. It's these are challenging dynamics to kind of play out. I guess, Hugh, let's get you involved a little bit. So let's take what we've heard from everybody so far and think a little bit about what you expect, how you expect the rate environment to sort of play out. You know, and you can sort of pick your poison in terms of what duration you're looking for. Obviously, shorter is probably a touch more predictable than a little bit further out, but none is probably all that predictable. But what's your general inclination for rates as we look out, you know, for the next 6 months or so?
Sure. Well, the first thing I'd say is that, you know, this the situation it's unprecedented in a number of ways. But one, I remember when everything first hit and the first wave of sanctions, you know, came, and you know, we spend, as everyone here does, you know, a lot of time on this, you know, making sure that you're in compliance, figuring out what you can and can't do, how entities are affected by sanctions, the type of sanctions, whether And I remember spending that weekend on all of this and with our sanctions lawyers and figuring essentially, and having some very heated discussions with, my partner, Bob Burke, about, placing some of our own feelings aside and, doing right things for shareholders. And then it was a bit stunning talking to our institutional shareholders who were supremely uninterested in the legal intricacies of whether you could do this or whether you could do that, and very much on a, we don't want to hear about, we don't want to hear about the word Russia. I mean, and we, and so, it's something that I haven't quite seen before. Like in general, we, whether we can trade to Venezuela or not is something that's changed over time with different types of primary and secondary sanctions. And we've always followed the law very, very carefully. But this is something that has been very different for us. And so I think in some ways, the way that same process is running through other decisions being made right now by oil companies and things, which is essentially the level of suboptimal financial and product sourcing they're willing to endure to satisfy their customers as well as their shareholders and stakeholders, is something that drives this inefficiency and maybe makes it even a bit more so than it otherwise would be. So I think we're starting to see that already in especially on the product side, as people had mentioned. There's a real shortage of diesel in Europe. Refining margins are through the roof. The arbitrage is open there, and product is being sourced, from Asia. The movement of diesel from U.S. to Europe had really evaporated over the last couple of years. That's coming back, and so we're seeing that, and the MR market has really moved, nicely. So it's sort of averaging, I'd say, like right now, like low 20,000s overall, at least what we're seeing short run with the pools, and on a trailing basis, probably very high teens. And we're also seeing in the Afras and the Suez things getting a bit better, and especially there where Sovcomflot have 6-7% of the global Aframax fleet, pulling that capacity out or rendering it suboptimal and doing not the natural trades, I think is supportive there, and those markets tend to move in tandem. So as people said a few times, the Vs haven't really seen much there. I think they will. And I just close by sort of saying, overall, our business is about supply and demand for oil and additions and subtractions to inventory. And in 2020, the world stopped consuming oil and was still producing it. And we had a wonderful couple months, and then we've suffered from these super high inventory levels. And today we have the opposite. We have inventories that have drawn well below really where it's safe to have them. And now we've got a shock on the supply side, and exactly how much it is that's been coming out from Russia is debatable, but it's some amount. And we think that with a backdrop of a really strong fleet demographic story, just means that we're in a very supportive environment overall for the next 6, 12, 24 months that we haven't seen for a while.
That's really helpful and great color. Harry, let's sort of go to you, and I'm curious to maybe pick up on the point that Hugh made about investor sentiment around trade and how you manage your fleet, and if you've heard that expressed as well. And then, maybe if you could talk a little bit about inventory levels and your expectations, around the next 6 months of the year.
Thanks, Christian. Well, as everyone stated, and as we can see, everything is in a state of flux. We don't know when that war will end. We don't know its long, if it has any long-lasting impact on the world and world trade, and potentially how that could affect, major oil routes. For example, we are seeing today, and going on some earlier points that were made. Some of the Russian tankers, for example, that they are naturally in a quasi-pariah state, if you like, status, that they are trading to the Far East, China, India. So they are creating a void that this could potentially be filled by other, vessels from, non-Russian entities. So that could potentially have a benefit for the rest of us, if you like. Investors are seeing that. I think they are taking a cautious approach, because on the one hand, for example, for the smaller trades, we see rates that have really gone through the roof. However, on the spot market for the big vessels, we're seeing rates not being able to bounce at levels that we feel make sense. We have a lot of interest for long-term contracts. We are communicating this to our investors. We are, as you know, historically, we have been a time charter-oriented company. I mean, today, approximately close to, call it, 65 to 70% of the fleet is on long-term contracts. So in a way, we're a bit fortunate that we have avoided all these wild gyrations that the market is providing vis-a-vis rates, and hopefully that should translate to investors getting a clearer picture, at least as far as TEN is concerned, on how we are navigating this current crisis. We do not expect that it will affect the company, not at all. Obviously, everyone we're in it together, all of the companies in the panel. So we need to see an end to it. If not, then the best thing that could happen, and I think that the best on the call it ethical humanitarian perspective, is for the EU to ban completely any exports of Russian crude. That will be on the economic side beneficial for tanker operators, and obviously it will have an impact on increase in ton-mile demand, particularly from places like the US. So we're hoping that all of this will resonate with investors. I hope that energy is coming back into the fray, because, as you know, up until recently, energy was a bad word. However, now people realize that energy is in the core of our lives and the world economy, and I think it will continue to be that over the next, if not, I wouldn't say generations, but certainly the next decade. So energy is here to stay, and we need to find a solution. And in the interim, we're doing our best to offer comfort on both to our charterers and obviously to investors that follow the company and have invested in TEN. It's too early to make predictions on inventories. It all depends, how, again, for example, how protracted this war will be. For example, one potential, and to see the dynamics, for example, the Russians, eventually they might run out of storing oil because they have limited storage capacity. So that could potentially lead to a decrease in their production. We could see the opposite in oil exporting countries, that they will start exporting some of that oil in order to fill the void that the Russian sanctions would create. So all in all, we are all on the sidelines, hoping for the best, but also preparing the company to meet the challenges of the future. But as a company, we are following whatever our charterers are requesting, and we just hope that eventually this will get translated to better valuations vis-a-vis the company stock by virtue of being a public company.
Yeah. Okay. No, that's really helpful. Lois, I wanted to get your perspective on some of the dynamics we're hearing out of Asia, but China particularly. So zero COVID tolerance policies are quite disruptive to broader trade. And I know that's more of a container market dynamic, but I wanted to get maybe more of a perspective of what you think that means about demand going forward. I think there's a big concern about, overall economic health of Europe and the United States and the sustainability of that in a very elevated, a commodity price environment. And you throw in, China kind of turning on and off and on and off, back and forth. How do you think that influences demand as you think out over the next several quarters?
Well, in 2022, we started the year and China hosted the Olympics. We knew they wanted blue skies, so that was lower consumption. Now, we're seeing that they're locking down a lot of Shanghai. So, this affects the tanker market as well. And I think it affects it in the very immediate term, right? Because then, you just have fewer people traveling, right? That plays into our overall ton mile demand picture, and obviously China being a massive importer and really a key anchor to overall big ship and these tanker demand. So, we all watch what happens in China, very carefully and see that. I don't see that particularly having a longer term effect. I think that, and we just have to see here, what the Omicron variant does and how they're, whether or not they're successful with this lockdown and kind of how that plays out, right? So, to that extent, we're seeing that, we're seeing that impact, and I can't wait for it to be over. I mean, we're heading into our third year here of COVID, right? There's 11 billion shots. I almost quit looking every day. 11 billion shots have been given in the world, and I think everybody is ready for it to be done. And you're seeing road traffic back up in most of the world. You're seeing air traffic back up. And, last week, in New York City, we hosted 3 different European counterparts that had traveled, right? So, you're starting to see overall life getting back to happening, and people traveling and getting on with their business, right? And I think that's a result that the Omicron, knock on wood, that we don't get another one worse, was much more mild, and the fatality rates were much lower, and patient outcomes were significantly better, right? So, Hugh touched on it a lot. Behind the scenes, demand has been coming back, and inventories have come down. So you're in a situation where everybody thought we would already be in stockpiling, right? Inventories going up in the first quarter already of 2022, and then that has kind of been flipped on its ear a little bit. And remember that China is loosening their financial policy at the same time that we're tightening our financial policy right here. So not every country in the world is on the same economic place, right? So I see 2-year Treasury rates spiking up, and that's not over the last week or so. And you when you get to an inverted curve, then you get concerned about growth, right?
Yeah, absolutely. It's a hard sort of world to decipher as it stands right now, and I guess it feels like things are evolving, and I think Harry made an interesting point about sort of this transition. So there's been a lot of discussion about energy transition towards cleaner fuels, and maybe the perception was we didn't really understand how vulnerable we were during transition periods, and maybe how long these transition periods could be. So, Lars, maybe a question for you. Curious to get a sense of whether you think we might see some more wholesale investing in capacity and the industry in general, where we've seen, frankly, a little bit of a lack of investment for understandable reasons, whether we understand what the propulsion systems will look like several years from now, what the requirements around emissions will look like, and what ultimately, consumers, when they think about scope 3, 2 and 3 carbon emissions, will be willing to tolerate. So I guess maybe a big picture question for you, Lars, what do you think investment looks like in this space over the course of the next couple of years?
Well, I think kind of the general volatility we've seen over the last year and a half, maybe 2 years even, particularly on the viable propulsion technology that people have been looking at has been dual fuel with kind of LNG and diesel, and when you make an investment case to add, say, $10, $12, $13 million to your building costs to have this ability to switch, when you did that, you were looking back in the mirror, and you knew that LNG was always going to be cheap. Well, it isn't, and it won't. I'm hearing day in, day out of kind of dual fuel vessels that are running on VLSFO or diesel, you know, and even the LNG tankers themselves would rather do fuel. So I think it's shot a massive hole into kind of this propulsion transition for tankers, at least for a significant time, because we're not ready for ammonia yet, and we're not ready for hydrogen. And again, you know, ship owners are not there to take these massive risks on their balance sheets to make these kind of road choices, which might actually end up being the wrong kind of lane to follow. And another part of your question was, you know, when you talk about scope 2, scope 3 emissions and so forth, I think I need to kind of put some cold water in the veins of the listeners here, because we have yet to see any charterer in the world willing to pay a premium for a low emitting vessel. You know, you get absolutely zero you know, for having an eco scrubber vessel. It only allows you to run your ship a little bit cheaper, but the charterer is not willing to pay more. If he's looking at a eco scrubber VLCC built in 2020 and a 2014 built non-eco without the scrubber, he will choose the cheapest one. You know, who offers the lowest rate. And it's you know, I like to say sometimes that the boardroom ambitions haven't drizzled down to the decision makers that we're facing every day in the market. And but that will change. It has to change, obviously. But so far there is absolutely no interest in the kind of the low emissions or the benefits of that. The only reason to where you can get by that is when, you know, you actually get paid for the low emission. So that will be, you know, when a oil major or a refiner or whatever, you know, imposes either an internal tax, a budget or whatever to their kind of the guys that are actually chartering our ships, then that might change. So I'm actually quite bearish. You know, the energy transition in shipping, basically due to the adverse price activities we've had on the various fuels, and also that, you know, we might need to step further kind of down the technology road, and that's going to take longer. You know, we kind of ammonia on a deep ocean going vessel, you know, it's not viable just right now. So I think we'll have to do with the kits we have. And actually, we, you know, circling back to some of the other kind of speakers there, we actually have a little bit of a bigger problem, and that's the fact that the world is short oil. And this was actually obvious even before Russia invaded Ukraine. You know, the world consumed 100 million barrels per day of oil in December, and that's with about half the world not flying yet. So it's you know, this is what we're up against.
Yeah, absolutely. So I guess, Brian, I saw you nodding your head. I wanted to get your perspective on when you think about investment in the space, and obviously you guys are a large player. How do you think about this? I think Lars brought up some really interesting points about what you would be investing in, right? I mean, it's hard to invest if you have no idea what you really want to invest in and ultimately what the returns of those investments might look like. So how do you think that translates to the order book over the next year or two?
Well, I think it's a positive for the order book, and you've seen that I think we're getting into, we're almost at the end of this quarter. I think we've had one VLCC ordered in the last 3 quarters, including this one. I think there's a real barbell with the high prices at the recycling end and the high prices at the new build end. You know, you've been quoted 115 million for a new VLCC, you know, plain vanilla. That's going to be very, very, you've got to make a lot of assumptions to get a return on that. Well, what I liked about Lars's points were very, very positive and very well structured, was that, yeah, he's absolutely right. The boardroom ambition isn't being felt upon the praise at the coalface. But what we are seeing a little bit in the middle is our investors, and I mean in terms of the buying of the stock, are a bit more pragmatic, and that needle has moved for us, and we're very encouraged by that there's a pragmatism, because they've missed out, a lot of these investors, on big returns from oil stocks and old energy, as it were. But I think they're also more pragmatic to know that we need to have an investment, and all the guys on this particular call are focused on having that latest technology. So I think there's a changing, if you like, a more of a pragmatic view, but it hasn't, as Lars says, sort of got down to the people on the ground. But in terms of where we're investing, we're trying to future-proof the 8 or 6 vessels we've still got to take delivery on, and that means putting the pipe work and strengthening the decks and everything else to make sure that they can take that new technology when it's available. Lars is absolutely right that the ammonia is still some way away, but we're working hard with our joint development program. But we're also, I think we've all been consistent amongst the panelists here, that there isn't going to be a one-size-fits-all. It is going to be a little bit of a mix and match, and it isn't just about picking the right technology. It's about that being viable. You know, if you go down the methanol route, just as an example, you know, you've got to power the ships that we've all got under our command. You need a lot of methanol, so you know it's got to be the right fuel as well. So I think there's a lot of structural issues, and Lars is absolutely right to highlight those. But we're encouraged that one part of that mix, in terms of the investors from the capital markets, in our experience over the last 3 to 6 months, have become a lot more pragmatic and are a lot more open. And I think they want to invest. Before it was black and white. I think a year ago we had this conversation. I'm either in oil or I'm not. Now there's an element of saying, look, I'm going to be in oil, or in the right companies, the companies that are doing the investment, the companies that are going to tick those boxes for me in terms of that rounded investment process and looking to invest in the future. That is definitely a positive, if you like, side effect of what we've seen, and that's what hopefully will continue to permeate down. As Lars alluded to, from the boardroom all the way down to those people. But things will have to change. We're going to have to get used to paying for these, as he rightly pointed out, and we need some proper carbon pricing as a bare minimum on that.
Yeah, Hugh, would love to get your perspective on this as well. I think the order book's a big question mark we get from investors over time, and obviously this sort of interest, renewed interest in the energy complex has sort of brought that question up. Is sort of, what do we do? What does this industry do to sort of move forward from where we are? Otherwise, we're left with the fleet, which is sort of aging out naturally over time. So, what's your perspective?
And and I think that's positive, and we I think there are a couple of things that are different about our model, being private and being private with a sort of a series of specific individual investments. And I think it changes your view a little bit. If you're a large company with a broad range of assets, you might invest to future-proof some vessels, even when on a standalone basis, look just at that vessel. It may not be, an obvious best use of capital. When we're looking at it on the private side, it's very hard to justify a new building to begin with, and to take sort of a 25-year view on when we see peak demand and what the overall dynamics are going to look like, much less to add $10 to $13 million to a new building price, unless it's underwritten by a charter, such as Lois had when Shell had their LNG project. So there are some exceptions, but when we look at a particular opportunity, and we've generally looked a little bit older, where the capital cost is lower, but also where we're confident that when we take these assets, we can make the investments and change essentially change the trajectory of the carbon emissions, where we can take a ship that would have been by 2026 a D-rated, in the new CII rules, and make it a B. And we have found some investors who are responsive to that, and increasingly we found investors who I think are speaking more of the language of transition, has been talked here. There's an understanding, there's an implicit assumption, I think, in the anti-fossil fuels entirely, that energy was sort of abundant, cheap, and secure, and that's all been tested right now. And it's, I don't want to say it was arrogance, probably more a bit of complacency. It's just that it's there. I don't have to worry about it, and I don't have to invest in it. There was an interesting article in the Wall Street Journal today about, what is, if the moral imperative, of today is getting weapons to the Ukrainians, is investing in weapons, still an ESG taboo? I mean, and these, I think, are questions that are opening up somewhat. I think at the same time, a lot of us, have to resist feeling that it's some, a sort of a longer term change. There still is, there's an energy transition happening, away from fossil fuels, and it's going to be something that impacts our business, over the next several decades. And what we do now is going to, have to change what we carry, how we change things, which is why we tend to continue to focus on sort of, 5-year chunks. What can we do with a fleet of ships to buy them at a low price, finance them properly, earn as much money as we can, sell them, return that money to investors, and, by our ownership, improve the carbon footprint and the emissions of that fleet while we own it.
Got it. That's very helpful. Harry, wanted to get your perspective on all of this and how sort of 10 sees where 10 sees opportunities in the market and how you guys are thinking about deploying capital from your shareholders.
So we have already grasped that opportunity, if you like, just by the virtue of our recent ordering of 4 Aframax tankers dual fuel to a very well-known oil major. So that's something that we have already proceeded with. Obviously, it's still kind of the first phase, if you like, of such a transition. We would need to monitor the situation as it kind of evolves, as it develops, vis-a-vis, the new propulsion systems, potential, alternative fuels, and what have you. So in order to, if you like, quote unquote experiment, for the lack of a better word, go into these new fields, we wouldn't have done it without an underlying contract. Even though the order book today is at historical lows, which in a normal world, this should have translated to skyrocketing, levels. We are venturing into this new field by having the security of call it potentially, a AAA rated charter. So that gives us a comfort to explore, that field and potentially, order more vessels. As you can appreciate, to go into these new areas, these new technologies, just by default, you need to order vessels. There are no vessels in the water that, with latest technology that are for sale. So you need to go out and put pen on paper and take the deep dive. All in all, we are on the forefront, we like to think, of such advancements. We like to do it in a modest way. And a case in point was our LNG investments that we never, and thank God, we never went with massive orders when we felt that everything was, in terms of technology, it was in a state of flux. And we were right on that as things evolved. Similarly with scrubbers, I mean, we have avoided and have been public in opposing the use of scrubbers. The only time that we had vessels with scrubber technology was only when our charterers, again with new buildings, paid for it. But time will tell. The jury's still out, both on scrubbers and the dual fuel. We still need to see how the vessels will perform over the next, I would say, 10 years, because the vessels, you cannot judge a vessel by a single trade or just by a quarter. You need to see the whole operation of the vessel through, through the various cycles, through its trading, if it does spot trading, if it does time charter trading. So it's more complicated than that. All the prior, co-panelists had some excellent points, but we need to look forward. We always need to analyze and assess new developments, but we should not just jump on an opportunity without really analyzing its long-term impacts. And as I mentioned, in our case, we just felt very comfortable in venturing into the dual fuel technology just by the status of the underlying charter. We're looking at similar transactions, attractive transactions that offer us, a very good return for taking this leap, if you like, and we will see how that goes. If it's something that we feel merits further investments, absolutely, we are here to explore deals like that. In the end of the day, as the company has grown over the years, by virtue of building its own fleet, we're always here to listen and meet the demands of our clients. So it's dual fuel today. It might be, I don't know, tri-fuel tomorrow. We are here to build such vessels as long as we get, a good charter against that. But overall, transition is in it transition, or the thought of the transition. I don't think we have finalized what the alternative would be. It takes time, and once I think we have some kind of direction where when the dust, if you like, will settle, and from that point onwards, it takes time. It takes time for that technology that will be the dominant technology going forward to be adopted. So we still have a long way to go before we get to that one technology that vessels will run under over the next decades.
Got it. Lois, what's International Seaways' perspective, and what are you telling investors you see opportunities in, and how are you deploying capital?
So, we sort of look at it in tranches. He was saying in 5 years, you're looking at, okay, here's my existing fleet, and taking each of the age sectors and saying, okay, let's make sure that every one of our ships is going to get the best possible score that it can get. And we are investing, we're putting 10 Suezmaxes through dry dock this year, and we are investing in, the extra $300,000 for the advanced hull coatings that we're going to put on those ships to gain that additional efficiency. And you do run a calculation on how does that return, and but that calculation is a lot easier. That decision is a lot easier than it used to be, because you have that extra efficiency factor that is, your ship's going to have a better score and incremental improved consumption, right? So we look at the existing fleet, we look at tomorrow, right? We're looking, the dual fuel VLCCs, and congratulations to Harry there on their project. Those vessels will be able to meet the regulations into the middle of 2040, right? So, you have, we're all looking forward, and I do think that our partners, meaning our customers, we're going to have to try and figure out how to work with them, and in a bespoke manner, start to get closer to the customers, in the sense that in order to innovate, an owner has to have a partner to take that additional capital risk. So I think that's something that we're starting to see, and I'd like to see a lot more of it in the market. I think there's a lot of room for that. There's a portion of the barrels that are traded barrels, but there's a huge percentage of the cargo that we trade on both crude and products that is base demand. And that could have bespoke solutions with some of our customers. So I think that's going to become a bigger component. So, there's what can you order today, which is largely just the dual fuel. And then there's the whole R&D element, where as owners, we have to take that responsibility to, and Euronav mentioned it, Brian talked about it, where they're saying, okay, they're strengthening the deck. They're getting those new building ships ready to be able to trade, because the regulations are going to keep changing. And you can't expect, if you're taking a conventional engine today, new building out of the shipyard, that you're going to need to alter that vessel in the duration of its life. So there's like multiple components to your existing fleet, how you can trade them, how you can hold them. And then and even in your existing fleet, there's different age tranches. Then there's the new buildings and what technology is effective today. And then there's the future forward of all the new fuels. And, as owners, we haven't had to secure our fuel supply. So Maersk, with their methanol on their new building container ships, they're securing their bunker supply. So there's whole new elements that are coming into play for owners that, our bunker supply has been a commodity today. All of a sudden, it's not a commodity anymore.
Yep, that makes a lot of sense. I guess with the last few minutes that we have, I'm curious to get people's perspective on the market from an equities perspective. So ultimately, that's what I spend all of my time, focusing on. Need to understand the fundamentals, but how that translates to the stocks. And it seems to me that investors have looked at the group on a year-to-date basis and saw an opportunity around energy prices and ultimately disruption, and then maybe have lost a little bit of conviction. And I don't want to go too far with that, but what do you think we need to sort of see, or investors need to see, to get more sustainably bullish? It seems like with the order book being relatively constrained, and potentials for disruption and sort of the way that we source energy to change maybe more materially, maybe longer term, there's reasons to be optimistic. But maybe Brian, I'll start with you. I mean, what do you think what are you getting asked about from investors, and what do you think they need to see to be more bullish about the prospects on maybe a 1 year or 2 year forward basis?
Yeah, it's a really good question. I think investors, probably like most of the panelists, are suffering a little bit of fatigue because we always seem to be in this sort of perpetual state of it's going to be great tomorrow, don't worry. That's not meant to be a facetious answer. It's that there is some really positive medium-term sort of constructs here in terms of, you think about, there's a likelihood that you won't get a VLCC or Suezmax delivered to the world fleet in 2024. Because you're being quoted 2025 today, and there's none scheduled for 2024. So there's some good visibility coming. We've got, an order book at a 25-year low. We've got an average fleet age in the larger categories at a 25-year high. Those are really good structural elements. But investors, I think, are frustrated that they can't see the pathway to get there because, we get out of COVID and then we get disruption, which looks to be, on the face of it, positive for tankers, and then we're not too sure because there's not an immediate sort of apparent trend. I think investors are looking, for three things. I think some sequential improvement, albeit from a very low level, as we continue to see more oil supply coming through, and we hopefully continue to see that demand recovery that Lois talked about. I think secondly, they're looking for properly weighted and funded companies that are doing the right thing on the transition, and everyone on this call is doing that, and I think that gives them the comfort that they can have that as an energy transition holding. It's not something to be concerned about because it's got oil associated with it. And I just think the last thing they're looking for is, I think they're looking for, dare I say it, some sort of longevity to the cycle, and trying to move away from this sort of, you've got to purchase your tanker stock activity at the very perfect moment in terms of your entry and exit. I think if we can transition to those medium-term fundamentals, then we don't try and move away a little bit from this boom and bust. We're always going to have volatility within our space, but I think that's what the investors, I think, are really looking for. We're encouraged, certainly from a European perspective, which maybe not everyone in the schools has got that exposure to. There does seem to be more of a grown-up sort of pragmatic message coming through from investors, which I hope will last. But I think it's just getting that sort of those firmer, shorter-term footings and catalysts translating to that medium-term picture. Because the medium-term picture increasingly looks, really attractive, but it's the journey there. That's what I think investors are a little bit afraid of. We just need to try and give them that confidence and visibility that we can transition to that medium-term structure.
It's helpful. Lars, are you bullish medium-term?
Well, yes, but maybe a bit more muted than I used to be, because I'm suffering this illness of perpetual bullishness as well. But and I have to say though that this time last year I was incredibly bullish, but I was leaning on only EIA, IEA, OPEC, and everybody else assuming inventories we're gonna stop drawing on inventories, which we to this day haven't. But I would like to. Brian was 100% correct in at least my experience as well with investors. There's another thing as well, which I've seen today when I've had one-on-ones. There is some degree of the investors looking at tankers now are kind of asset allocating, because they've made money in containers, they made money on LNG, they made money on bulkers, and now they need to look at the black sheep of the shipping industry that continuously is
tired of making all that money.
Yeah. So we actually do see that as well, that people that are very familiar with the industry or with shipping in general, and kind of tankers is one of the sectors that have been left behind. and the fundamentals are there. We just need to sort out kind of oil.
Got it. Hugh, last word to you. Are you bullish medium term?
Yeah, I think, and of course we're not publicly traded, but I think Brian hit the nail on the head. You need to see some kind of a more like sustained environment that's supportive. And I think what we see, particularly because we are on slightly the older side, I mentioned the public getting complacent with cheap oil and all these things. I think in some ways we're complacent we've had very benign operating cost inflation environment for quite a long time. We've had very low interest rates for a long time, and we've had easy availability in shipyards and things for a long time. That's changing on the older side right now. It's shipyard costs for dry docks and repairs are going up quite a bit. Congestion in and out is difficult. China is difficult. And the older fleet have pushed off installing ballast water treatment systems as long as they can. You put all that against the last big tanker boom was the early 2000s, and we're now coming up. We've had low order books plenty of times in the last 10 years, but always against a very young fleet. So you assume, we've all made this mistake. Oh, we'll add 3%, but we'll get some retiring ships. We haven't seen that. I think now we're going to see it, and we're going to see it consistently over the next 5, 6, 7 years, which I think just sets up a much healthier dynamic for the kind of sustained, positive environment that Brian was saying. I think investors need to see.
Got it. I see Nicholas has emerged, and so I think that means that our time is up. So gentlemen and Lois, thank you so much for joining us. Really appreciate it. Nicholas, I'll turn it back to you.
Well, all I want to do is say thank you. Tremendous panel. Thank you, Chris, for a great moderating job, and of course to all the panelists for unique insight. And I think it was such a critical topic and very timely discussion. Thank you very much to all of you.
Thank you.
Take care, all.